Our stock of the day is Netwealth, reporting a rise in first half net profit to just over $39 million. Revenue also higher and an interim dividend of 14 cents a share. Looking ahead, the company flagging expects headcount growth in the second half of fiscal 24 to be slightly below the first half. And off the back of those numbers, we are pleased to welcome Netwealth Chief Executive Matt Heine. Matt, welcome. Thanks for joining us here on the call. Well, talk us through these numbers. How pleased are you?
Thanks, Andrew. Yeah, we're obviously really pleased with the results for the first half of 24. It's a very different business environment to what we found ourselves in last financial year, and we've seen incredibly strong growth across all of our metrics, and importantly, seen great growth in client numbers and also the number of intermediaries that are using the various products and platform technology that we offer.
So revenue driven largely there by high transaction revenue. Is that that's where your growth is?
No, not necessarily. So we've been very focused over the last many years on diversifying our revenue across a range of different areas. So the bulk of our revenue still comes from administration fees, but there's no doubt that the ancillary fees that we earn on things like share brokerage have certainly supported the results this half.
You did have a higher headcount there. Just how are you keeping those expenses under control at the moment?
Yes, we've got across the business and the different areas just shy of 600 staff now. So we put on 35 headcount in the first half, and as we announced, we expect that headcount growth to be slightly lower in the second half. But the reality is that we are an incredibly fast-growing business, and to make sure that we maintain that growth and continue to grow well into the future, we do need to increase headcount from time to time, as well as also make sure that we're putting in new staff into key positions. So we feel under control. But yeah, certainly something that we are watching.
When you say you're a fast-growing business there, how are you seeing your market share growth at the moment?
Yes, over the last 6 months, we've grown, I believe, by about 1.1%. So currently, our total market share of the direct platform market, which is about $1 trillion, we have about 7.4%. So looking forward, we've got no need to go overseas. We've got plenty of runway and a huge industry to keep tackling.
I guess the question is, can you maintain these earnings at this point?
Yeah, so certainly we've got a very long track record of sustained profits and EBIT and EBITDA margins. So it's really important to us that whilst we are consistently investing back into the business, and we have now for many, many years, that we do keep an eye on making sure that it's profitable growth. At the end of the day, we want to make sure that we're delivering strong underlying NPAT growth, but also making sure that we invest for the future as well. So it's just about getting that balance right.
You're in that investment management sector. You have obviously benefited, particularly in the wake of the Royal Commission, to the detriment, I guess, of some of the bigger banks and the like. I mean, do you see that continuing? And what's the approach, I guess, you're seeing from your clients at the moment?
Yes, the Royal Commission was definitely a bit of a watershed moment for the industry, and certainly it was a strong tailwind for Netwealth and the specialist platforms. I think subsequent to that, the market has changed quite significantly, and what we see is sort of systematic. We see playing out for quite some time. So there is still a significant shift from, I guess, the incumbent platforms. There's been a lot of M&A activity in the market, and so we've seen the banks largely divest their wealth businesses, and the market's going through a real period of fragmentation, both at a licensee level, also as a product and platform perspective. But coming through the other side, we're also seeing a lot of reconsolidation. So we're seeing the emergence of sort of super groups starting to form. All of that and that environment is fantastic for us and continues to throw up significant opportunities that we'll be making sure we make the most of.
Yeah, can you expand a little more on that when you talk about that M&A, the potential for consolidation there? How are you looking at that opportunity?
Yeah, so it does happen at different levels from time to time. So, subsequent to the Royal Commission, a number of the big wealth players have sold to either private equity, or in the case of someone like an Insignia, where they absorbed or in the process of absorbing MLC. And we've also seen a lot of the licensees. So in licensee land, so that is the licenses that then allow financial advisors to operate. we've seen a number of mergers and acquisitions in that space, and we saw the court approval of Count and the Diverger Group last week, and we expect to see more of that. So as these groups get bigger and bigger, they inherit advisors that are in many cases using our platform, and that gives us great opportunities to then go and speak to the broader network. So consolidation, fragmentation is all great for us. And the other area that we're seeing quite a lot of growth at the moment is through overseas capital and also local capital buying into financial planning businesses and doing roll-ups, if you like. So another emergence of what we think will ultimately be mega groups in the market.
Matt, how are your funds under management? What's that level at the moment, and what trend are you seeing there?
So just to take a step back, so we talk about funds under administration. So that is money that comes onto the Netwealth platform. And then we talk about funds under management, which is when that money then is invested into products that we manufacture. So funds under management currently sits at about 18 billion, and we've seen really good, strong growth, primarily into our managed account product. So the managed account product allows investors and advisors to effectively rebalance or access fund manager IP at scale, and then we look after all of the ongoing rebalancing and maintenance of those individual models. So that grew to recently $16 billion in the managed account, and also then we've got a set of managed funds which are continuing to grow as well. So really good growth across all of our products, including a number that we launched during the course of last year.
And Matt, how are the cash balances looking there, particularly, I guess, given the lure of term deposits, given where interest rates are at?
Yeah, it's been an interesting 12 to 18 months. So the amount of money going into term deposits, both on platform and also off platform, has been pretty astounding. In my 23 odd years working at Netwealth, we've never seen that sort of money going into them ever, to be honest. And so over the course of last year, we put in a range of initiatives to make it easier for advisors and also clients to manage all of their fixed income on the Netwealth platform, to avoid them having to, I guess, move money and look for better rates elsewhere. So we've added a huge number of new term deposit providers. We've added small parcel bonds. We've given advisors and clients the ability to negotiate advice fees where they don't necessarily have to pay them on fixed interest component of their portfolio. And all of those different initiatives we're starting to see really play out and money moving back onto platform where it may have been taken off. But cash balances, they'll move from time to time. Certainly as markets improve, as they have over the last couple of months, we see money being invested, which obviously reduces the cash balance, and as a percentage of our total funds under administration, it will reduce, but they're fairly stable at the moment.
Matt, thanks so much for the update from Netwealth.
Thanks for having us on the show.
All right, well, let's get into some analysis, given what we've just heard, and off the back of their numbers, obviously. Mark, let's start with you, given what you saw with their result and also what Matt just had to say. Mm-hmm. How do you look at Netwealth?
Well, Netwealth is a quality business. We've actually spent some time on it and done some work on it. It passes all our filters, so from a Team Invest point of view, it meets all our conscious investor ratios. The couple of issues we have is we're concerned about the ability for them to keep growing at 17% a year, which is what their earnings have been growing at, which is great, and it's quite stable. So they've been very consistent, which is really good. But because the market is being driven by sort of a restructuring, if you like, Hub24 is also doing very well as well, which is one of their principal competitors. So the fragmentation of the market is really playing well to these guys. So we wonder how long that can last. So now he was saying there that it's going to keep going and there's lots of opportunities. Great. The problem with that is the PE ratio. It's currently on 64 times earnings, which if the earnings start dropping off from 17 to 10 or something like that, then there's real capital risk issues on the share price. So quality business, we like it. We don't think the moats are that strong, but we may be wrong. I mean, we haven't got into a lot of detail. In other words, how sticky are the clients once they're in, depending on which part of the business, of course, because there's different parts. And they're all different in how they work. We're showing the return. If you wanted to get a 10% on a margin of safety, which we would want as a minimum, you couldn't pay more than $13.25 for it. It's currently $17.60. And could it go down to $13.25? I'll just tell you what it's done in the last year. Price. In the last 12 months, it was $11.86 within the last 12 months. And then the year before was $11.36 low, and then 10 before that. So too expensive at the moment.
Right.
But good business. I'd want to buy it, as I said, about $12. If I was going to buy it.
So looking to buy, but potentially.
Well, I'm not actually looking to buy. I'm just saying that.
Well, no, but if you were looking for a price point,
it would make
it'd be lower.
sense to Team Invest members as a risk reward at about $12.50.
Yep. Okay. All right. David, then, how do you look at it? And I guess particularly also given its valuation at the moment, where the share price has actually performed very well of late.
Yeah, look, I endorse everything that Mark just said. I can't really add much more to that. I think on valuation basis, it's looking very expensive, technically as well. If I look at the charts, if you look at the technicals, even if you go back to 2021 or even further back, this is what they call a major resistance level, selling level up here. So I'd certainly, there you go, that's what the level I'm talking about, where it is now. And it's market driven. So if you look at that rally, it's gone from $12 to $18. So it's had a 50% rally since the October low. So it's very much driven by the market sentiment. So I would be taking some profits up here. I certainly wouldn't buy up here. But if you bought at lower levels, I think it's a great opportunity to take some profits.
I'd agree with that.
Yep. Okay. Well, it's agreement then for taking profit on Netwealth, given where it's run. That is our stock of the day. All right.